been like 10 minutes. So we'll go jump into it. All right, everyone. So chapter 2, essentially what you're doing here is you're learning about all the different types of costs. Cost, behavior, analysis. And if anyone ever can't understand my handwriting, please let me know and I'll write more clearly. I do not have beautiful handwriting, okay? So, guys, cost, behavior, analysis. Now, all these costs, guys, you know to some degree. What we're doing here today and in managerial accounting is we're just putting everything in a managerial accounting context, okay? So, guys, in managerial accounting, first off, everything we use here is for internal purposes. This information is all for managers. Essentially, what you're doing during the midterm is you are tracking costs. Because, guys, essentially this course is accounting for decision making. At the end of this course, you're going to be making decisions as managers with financial information. So, guys, if you want to make good decisions as a manager, you have to know how much your products cost. You have to know how much your services cost. All right? If you want to know how much profit you're making, you have to know how much stuff costs you. So, let's go classify all the different ways we look at costs. And I guarantee you guys already know most of this stuff. All right. So the first way we classify costs is product or period costs. Okay. So first off, let's go over product costs. Okay. Product costs, guys, are all costs incurred in manufacturing or making the product. All right. So costs involved in manufacturing, I'll even write / producing the product. Okay, does that make sense? Product costs is the cost of producing your product. Now, everyone, we have to go look through the 3 abbreviations for product costs, and you will be seeing these abbreviations all semester. So the first product cost you'll see is DM, right? If you want to make a product, you need direct material. So what is direct material? So we'll write it down quickly. Direct material is all material directly traced to the product. Okay? What that essentially means is any material that you could directly see on the product itself. If I were to hand you a product, if I were to put it in your hands, you can easily point out what the direct material is. Okay? We'll go over some examples a little bit later. The next thing that we need, right? If we're making a product, we need material. We need now direct labor. DL, DM, DL. Okay? What direct labor is, it's all labor used directly in creating the product. Okay? What that means is that any labor worker that physically puts their hands on the product to make it is considered a direct labor worker. Okay? And lastly, guys, we have the material, the direct material. We have our workers, the direct labor workers. The last thing that we need to make a product is manufacturing overhead, MOH. Now, guys, the definition of MOH is, I'll write it down and then I'll simplify it a little bit more. The definition for MOH is all indirect costs in producing the product. All right, and what does that essentially mean? Okay, so guys, manufacturing overhead, the way I like to simplify it is, it's everything you need to make the product that you can't actually see on the product itself, right, guys? So like when you're making a product, you need a factory. When you're making a product, you need a boss. You need stuff that's like that you can't actually see on the product, but they're costs that need to be incurred to make it happen. They're like support costs in the manufacturing process, right, guys? You can't just go like make stuff in the middle. You can't go like make iPhones in the middle of the street. You need to get a factory, you know? So these were all the indirect costs come in. It's costs that we can't see on the product, but we need to make it happen. I always like to say, guys, because an example of like MOH is factory depreciation. When you're looking at someone's Yeezys, you don't comment, hey, sick factory depreciation, bro, right? It's stuff that you have to see on the product. MOH, you don't see it, okay? It's all stuff that's that you need to make the product that you can't see on the product itself, okay? So now, let's go into examples of MOH because this sometimes confuses students. So MOH examples. All right, let me drag that over here. So different types of MOH. First off, we have indirect materials. That's stuff like glue, guys. Like when you, like if you buy a product and you see glue on it, well, obviously unless it's like a glue stick, you return it, okay? Your product should not be covered in glue, okay? That stuff, remember what MOH represents. All stuff you need to make a product that you shouldn't see on it, okay? So that's an example of indirect material, stuff like glue. All right, another example of MOH is indirect labor. That's stuff like we spoke about before. Your manager, right? Your manager is just sitting on the side telling you what to do. They don't actually put their hands on anything you're making, right? Does everyone understand that? That is what direct labor represents. It's the cost that you need. Well, it's like the cost of the person doing work, but you can't actually see it on the product itself. All right, the manager is not actually doing the work. They're kind of like managing around, forcing you what to do. Okay, does that make sense to everyone so far? These indirect materials, stuff we can't see on the product. Indirect labor workers don't actually touch the product, but we need managers to, you know, make the show happen, make the party go on. Okay, the next example of MOH is factory depreciation. All right, so your factory is going to depreciate, guys. That is a cost in producing the product because at some point you will have to get a new factory. So you have to make sure you price that into your product, how much it is how much your factory is depreciating. All right, another example of MOH is factory utilities. That's stuff like a heating bill, factory utilities, electricity, all that type of stuff. You don't see your electricity bill on your new pair of Yeezys, therefore it is MOH. Okay, next up is like factory taxes, right? When you look at your nice new product, you don't see taxes on it, and factory insurance. Okay, now guys, this is essentially why product costs are important. If we track all these costs correctly, all right, and we need to, if we want to be a good manager, if we want to make good decisions, we need to track our costs properly. All right, so why these costs are important is, guys, is these three costs will lead to the value of your inventory. Because it's the cost of making the product, when you're actually done making it, this account, your inventory account on your balance sheet will represent these costs, all right? So why are product costs important? They lead to the value of your inventory, all right? And then afterwards, when you sell it, then it goes to your cost of goods sold. All right, that's why product costs are important. We need to know how much our inventory is, so when we sell it, we can account for it properly, okay? I'll give everyone a chance to write this down. Hope everyone's okay so far. Give me a second or two. Okay, guys, now let's go over the next type of cost. So we covered product costs, and this is it for product costs. Now, let's go into period costs, all right? Let's go into period costs here. If I'm going too fast, just let me know, and I will happily slow down and give you guys another minute or so. How does the product cost account into the inventory? So essentially, when you're making a product, let's say we're making like a pair of shoes, right? We're making a pair of Yeezys. Okay, we need we need shoelaces or leather or fabric. Okay, we need fabric, right? Then we need workers. We need assembly line workers to put that together, and then we need a manager. Right? Let's say manager among all the other million things in manufacturing overhead. Okay, these three costs, right, will be incurred in making the product. Now, when the product is done, okay. When the product is done, you can say, well, the cost of all the fabric we put into the shoes, the cost of the manager, or the assembly line workers, and the cost of the manager will all be factored into, what is it, the cost of the product, right? Because it's the cost of making it, that will appear on your inventory. Is that fair? So those three costs put together become the value of your inventory. I hope that's okay. I hope I explained that half decent. If there's any other questions, feel free to ask me later. Perfect. All right, now guys, period costs. So let me actually move this to the side here. I don't know why I centered it. So guys, period costs. Period costs are any costs incurred related to selling the product. So any cost related to selling the product. All right, guys? So this is how we classify costs. What's the cost of the products itself, and what's the cost of like how much it takes, like how much does it take to sell it? Okay. So guys, now these are different types of examples of period costs, and it's pretty straightforward. So first off, if you see selling expenses, you know that's a period cost, right? Because it literally says selling in there. In your problems, guys, you'll have to differentiate between what cost I incur in making the product and what cost did I incur in selling it. So first off, we have our selling expenses. Next type of expense incurred in selling is administrative, admin expenses. Okay? Other things you'll see here is office rent. If you have to rent an office, all right, to sell your stuff, right? Office utilities. And stuff like advertising. You guys know advertising has to do with selling it, right? Advertising. And then you have stuff like commission. All right? Those are all different types of examples of period costs. When you're differentiating between product costs and period costs, guys, really think, is this a cost I incurred in making it or selling it? Delivery is also a good example. Yeah, delivery, shipping. Good job. See, those are generally the examples I put, but delivery is also a good one. I'll write it down for you guys. I'm really happy you guys are actually like getting like farther into this and really pointing that out. That's good. There's like a million examples. If we want to point out all the period costs, we'll literally be here all day. Okay? Because there's so many different costs involved in selling a product. I just give you guys the basic examples I'm so used to seeing. All right? Delivery is a good one though. So is a manager part of admin expenses? So that's actually a really good question because a lot of times students will confuse between period costs and product costs. This is what we have to do. Okay? We have to know, is this manager involved in selling the product or is this manager involved in making it? Now, guys, luckily for you, how I like to teach is I like to give you tricks on the exam, how you can know something's a product cost or a period cost right away. Now, everyone, you will know something's a product cost right away if you see the word factory. All right? You know it's a product cost if you see the word factory, and I'll explain in just a second. You know something's a period cost if you see the word store or office, and I'll explain you the logic right now. So, everyone, let's say we want to buy an iPhone, okay? Imagine if you had to go to the Foxconn factory in China to go buy your iPhone. I'm pretty sure you would all be on Team Android in like a minute. I hear those factories are pretty nasty, all right? Guys, you make things out of a factory and you sell things out of a store. That is the logic. That's the way to simplify it. That's the easiest way I could put it for you. If you see factory anything, you know it is a product cost and don't question it. If you see the word store or office, you know it is a period cost, okay? So you have to look here. If you see factory manager, you know that is indirect labor and you put it into overhead. If you see store manager, you put it into your period expenses, okay? Is that clear? You have to look at, you really have to determine, guys, based on the business you're in and other circumstances, where is this worker working? What are they doing? What's their deal? Okay? Does everyone get that? The same for employees. Yeah, if you see assembly line worker, that's someone putting the products together, right? If you see, I don't know, like a guy who works on the phone, for example, like you'll see different when we go through problems later, right? It literally just making off the top of my head is like, it's gonna be more difficult because I'll just think of random examples. But in a problem, we'll see like the strategic process of getting through it. Is that okay? All right. Now, everyone, I hope that's very simple, okay? That's product cost and period costs. What costs go towards making the product? What costs go towards selling? Now, that's the first way to classify costs. So if everyone's okay, let's go into the next part. And guys, quickly for period costs, if you guys want to know like the big thing behind period costs, these go in the expense portion of your income statement. And don't worry, we'll go over it later for those who don't remember 217. They go into like your operating expense portion. Okay? So, all good so far, I hope. I hope I haven't lost anyone. All right, if I did, I'm sorry. You know, we'll get you back on track. If you have any questions, you can always message me. Okay, now guys, let's go into the next way we classify costs. We classify costs as either direct costs or indirect. All right, so essentially what this means is, guys, and you'll learn this a bit more in chapter 3, what costs can we trace to our product and what costs can't we trace? Guys, there's an issue behind indirect costs in the sense of this. Remember when I spoke about the heating bill? And if you're making a product, you have to factor that heating bill into the product somehow, right? Because you have to cover all your costs and then put a markup if you want to earn a profit. I hope everyone agrees with me. The issue with indirect costs is, guys, is we don't know how much of this heating bill goes into making like one pair of shoes. All right. How much of this how much of the heating bill should I factor in to one pair of shoes? So that's difficult. And we'll learn about something like a way to treat it in chapter 3. It's called an overhead rate. But for now, let's just distinct between direct costs and indirect costs. And now you guys know why indirect costs are a bit more annoying, because we can't track it, because we can't see it on the product. All right. So guys, for direct costs, let's just think of examples here. Okay. When we're looking at our costs, all right, which costs are direct of these three? Well, we know direct material is a direct cost. It literally says direct in it if you don't believe me. So DM is a direct cost and DL. Okay, we can track it straight to the product. We know how much material is on the product, and we know those assembly line workers, how much they built, how much they made. It's easy to track, okay, because they were directly involved. They actually touched the product. We know how much to cover based on how much they worked and did whatever. Is that okay? So DM and DL are direct costs because we can track it. Now, indirect costs. Which of these costs do you think in product costs are indirect? Anyone have a guess? Maybe manufacturing overhead, right? It even said here, all indirect costs in production. So the example of indirect costs, guys, is overhead. It is MOH. The reason is, guys, is remember what I said, the example with electricity. You don't know how much of your electricity bill, your heating bill, your manager's salary should be priced into the product, all right? So it has to be allocated, and we'll look at that in chapter 3, all right? So that's the difference between direct costs and indirect costs. Now, guys, there's 2 equations that we have to learn now, and I have a very easy way of learning it. So first off, let's go over the equation of total manufacturing cost. All right, and if you guys don't believe me, total manufacturing cost is the cost of manufacturing your product. Now, guys, we went over the 3 costs that we need to make any product. If you want to make a product, you need DM, you need material, all right? You need workers, you need DL. And then lastly, you need overhead. DM, DL, MOH. Get a t-shirt that says that, get it tattooed on your body, whatever it takes for you guys to remember it, okay? Total manufacturing cost, DM, DL, MOH. Now, guys, those costs are separated into 2 separate equations, and you'll get like maybe 1 question like this on your midterm, okay? So first off, we have prime costs. All right? And essentially, it's like priming it, getting it ready for production. So that's DM plus DL. All right? That is a prime cost. Now, next up, we have a conversion cost. And that is DL plus MOH. Okay? I hope my handwriting's okay. I hope everyone's understanding what I'm doing, what I'm saying. Maybe I need to go back to kindergarten and work on my D's. Wow, this is pretty messy. Okay? Now, everyone, this is the way I like to remember it. And it's just an easy way to, obviously, at the time of making this recording, you get a cheat sheet on your exam. But if you didn't have a cheat sheet on your exam, it's an easy way to remember it. I always like to say the left-hand side of the equation is prime and the right side is conversion. So look at this. So first off, let's make a little grid over here. DM plus DL. Well, I don't know why that's not going straight, but whatever, that's prime. You see how I see the left-hand side is the prime, and then the right-hand side is the conversion. Okay, I always say left-hand side of the equation, DM plus DL is prime cost, and the right side, DL plus MOH, is conversion cost. Is that simple enough? Easy way to remember? Just write the equation for total manufacturing cost. Just remember prime is the left side, and then the right side is conversion. Okay? So that's what we got so far. Everyone's okay? Did I completely lose any of you? I hope I didn't, because I got to move on to the next part. And we're starting to get into stuff like a little bit more complicated. All right? So if everyone is okay, just like raise your hand or something to indicate that I'm like, that I need to slow down. If you do, guys do want me to slow down? Okay, I'm going to slow down. That was a quick hand raise. That's some confidence right there, you know? Oh, wait a minute. Give it a second or 2. Or like maybe a minute or so. Oh, if I was good. Oh, no, I asked if I need to slow down. I'm so sorry. Okay, so I can move on. Is it chill? Do you guys want me to move on? Are period costs direct or indirect? Thing is, they can be, but for this course, no. You'll learn about that in like ACCO 330. Is that okay? If you guys are in accounting and move up a level, you'll see that in the next level of accounting. For now, you don't need to worry about direct or indirect costs for selling expenses. Can you explain the difference between prime and conversion costs? The reality is the difference is just like preparing the product to be made. Like priming is like getting it ready to like a base level, and then using DL and MOH, you like conversion to the final product. I've never actually seen a theory question on like what is prime and what is conversion cost. I've only seen like mathematically. So if you want, you could go read your textbook to get like the exact definition. If I remember, the textbook doesn't even give you like an exact definition. So you'd have to go look at it online. All right, so if that's what you want, you could go look it up. I've never personally seen a theory question on it. So how does the fact that it's left or right matter in this equation? It doesn't really matter. It's just like a trick to remember, right? Because they'll ask you, what is the prime cost? What is the conversion cost? So there's no like actual like big difference. It's just a trick to remember. All right, perfect. So let's move on. The next way we classify costs, guys, and guarantee you guys know this, is variable costs and fixed costs. So let's go to the next way we classify costs. Third way, variable and fixed costs. All right, now guys, when we're doing variable and fixed costs, I'm sure you guys already know what it is to some degree. So let's go over variable costs first. Okay, variable costs, guys, are costs that always change. Think about it, they vary, okay? So variable costs are costs that change as output changes, right? The more you want to make, the more it's going to cost you. Is that fair? Does everyone understand that? Now, guys, an example of variable costs. Let's think of one. I think a good example of variable costs, at least responds well to a lot of students. They understand it this way. Think about your wage. Think about your salary. The more your boss wants you to work, the more they're going to have to pay you. At least I hope. Okay? Variable costs are costs that are changing. So, guys, an example of variable costs, all right, is DM and it is DL. Okay? Because, guys, if you want to make more, you're going to need to order more direct material. You're going to need to go to your supplier and be like, yo, I need more. Okay? If you want to make more, you're going to need more workers, right? You need to get more employees on that floor building stuff. Okay? Does everyone understand that? DM and DL are variable costs. The more you want to make, the more material you need, the more workers you need. Now, guys, there is overhead as well. Now, where a lot of students get confused is overhead, technically it's a mixed cost, all right? But in this course, like mixed costs, like you only need to know it for like a theory, for like theory purposes. Like some costs could have variable and a fixed component to it. But reality, guys, when you get to chapter 6, when you distinguish them, there's only variable and fixed. When you're doing chapter 6, you'll see there's no mixed cost. A cost has to be either variable or fixed, all right? So you can know mixed cost just for like theory, but it's not that important, all right? So when we're looking at overhead, it's a mixed cost. All right, I'm going to erase this in a second. In overhead, we have a component called variable overhead, VOH, and we have a component called FOH, that's fixed overhead. All right, and let me go scroll up to my example for a second. All right, examples of variable overhead are like indirect materials and indirect labor. Examples of fixed overhead is depreciation and stuff like insurance. Okay, taxes I feel like could be variable overhead as well, like always changes, but that's really outside the scope of this course, dealing with taxes. Just know, guys, VOH are overhead costs that vary, and fixed overhead are overhead costs that are fixed. Like factory rent, guys. I didn't put rent in here. I really should have put factory rent. I'll put it over here. Fact rent. All right? Stuff like factory rent is an example of a fixed overhead cost. All right? So that is how we're separating it. We have DM, DL, and we have VOH over here as well. All right, overhead has to be split because it's a mixed cost. All right, let me go erase this now. So, guys, let's talk about what's the example of VOH. I think I just answered that, or maybe you asked that before. It's like indirect materials, indirect labor. That's the best examples of it. Now, guys, there's a very important part. Actually, you know what? Let's go over fixed costs and let's go through the relationship later. All right, so those are examples of variable costs, cost that changes, output changes. Now, let's go over a fixed cost. All right, and guys, a fixed cost never changes. Fixed costs are costs that remain the same remain the same as output changes. So the more you make, your fixed cost is never going to change. All right. So guys, a very good example of a fixed cost. Think about your rent. Okay. Your rent, no matter how many people you have living with you. Okay. Well, actually, we'll go over this example a little bit later. No matter how you want it, your rent, when you're paying your landlord, is like what, $1,000 a month, $1,500 a month, whatever it may be. I feel bad if it's like over 2,000. But you guys get the gist. A fixed cost is a cost that remains the same. Your rent is always, you're gonna have to go to your landlord and pay him $2,000 every month, no matter what. Now, guys, I'm sure you have some questions. You're like, wait, Matthew, it changes actually. It's not always the same amount based on the amount of roommates I have. And we'll go over that a little bit later. Just remember, guys, a fixed cost never changes. You wanna make 1 unit, you wanna make 1,000,000, that fixed cost is always staying there. So guys, an example of a fixed cost is fixed factory overhead, okay? FOH, fixed factory overhead. All right, now let's go into what I was speaking about a bit before, but like the roommates and whatnot for like fixed costs, and I'll actually like put it in a way that like makes way more sense. So guys, let's talk about variable costs in a very important relationship, in a way that you will get asked on your exam 100%, okay? So let's talk about variable costs quickly again, because there's an important relationship, okay? So I'm gonna write it out here and then I'm gonna explain it in a minute. So I know you guys are gonna be lost, so you just have to hold with me for like 1 minute. So variable costs are fixed per unit. And I know I'm losing some of you guys right now, okay? So variable costs are fixed per unit. I'm gonna explain what that means in just a minute, okay? Write that down. I know you're lost, all right? I'm gonna get you back on board though, trust me, all right? And to show you guys what I mean by that is, no matter what, guys, when I say variable cost is fixed per unit, let's go to your wage, for example, okay? Because whether you work 1 hour, 2 hours, 3 hours, 4, etc., do you agree with me that your wage will never change? The variable cost is always the same per unit, whereas the total variable cost is going to change. Whether you work 1 hour, 2 hours, or 3, the total amount your employer will have to pay you goes up, but your wage is always the same per hour. So this is where students make mistakes. They think that variable costs are changing. The reality is, guys, the total variable cost changes, but the variable cost per unit does not change, all right? Imagine if you guys worked, okay, and your wage went down every hour you worked. So like hour 1, you made $15, hour 2, you'd make $10. Quit that job. That's not good for you, okay? That's illegal, all right? So I'm gonna go show you guys like a little example here what I mean when variable costs per unit are fixed. All right, so let's go. Let's write number of units. Let's put a little example over here. VC per unit. And then total VC. All right, total variable cost. Now, in my example here, we're talking about wage. And let's say wage is $15 an hour. So guys, our number of units represents the amount of hours you're going to work, okay? So let's say you work 1 hour. Okay, your variable cost per unit is $15. Your employer has to pay $15 an hour. So that means your total variable cost will be $15. All right. Now, let's say you work a second hour. So let's say you work 2 hours. All right. Your variable cost per unit is still $15, right? Because you're paid $15 an hour, but now your total variable cost is $30. Let's say you want to work 3 hours, and I'll go forever until you guys get it. 3 hours, your variable cost per unit, well, your wage is still $15 an hour. Then afterwards, $45 your employer's gonna have to pay you. Does everyone see here? I'll write it out. Total VC changes. VC per unit stays same. I don't have room to write thus, so I'm using bad grammar here. VC per unit stays the same. Okay? The reason why this is important, guys, is Dr. Ali on the exam will tell you, hey, at 10,000 units, our variable costs are this and our fixed costs are that. Now, what is the cost if we make 20,000 units? So a lot of times a student will go make a mistake and change the VC per unit. The reality is, guys, if you're making 10,000, you're making 20,000, this variable cost per unit stays the same. All right? Don't be the person that makes that mistake. Remember, variable cost per unit is the same. The total is constantly changing. Okay? So if that's okay, if everyone gets that example, let's now go into the fixed example of fixed cost. All right. Now, guys, fixed costs. This is what we're talking about now here. And I went to the example like 1K rent per month. Okay, so let's talk about rent. Let's say your rent, guys, is 1K per month. All right. So let's do the same diagram before. Let's here write number of units. All right. Actually, you know what? I didn't write the example. A cost remains same as output changes. Actually, let me write the rule first before I put that. Sorry. So for fixed costs, guys, I'm going to lose you here, but I'll get you back on board. So fixed costs are variable per unit. So here, this is the part that's confusing. Variable costs are fixed per unit, and then fixed costs are variable per unit. And I know it sounds like opposite day. I may sound like I'm like just like speaking pure BS, but I swear I'm not. I'm going to bring it together. So when I say fixed costs are variable per unit, we're going to use the rent example. All right, so let's write number of units. Let's write FC per unit. And then let's put total FC, just to visualize this example for you. All right, and we'll talk about like the amount of roommates you have, okay? So let's say you're just you in your apartment, okay? You're one person. Your rent is $1,000 a month. So your fixed cost per unit is 1,000. Does everyone agree with me there? All right, now let's say you get a friend. Let's say you get a buddy. You're 2 units now. Your fixed cost still hasn't changed. Your rent is still $1,000 a month. But I want everyone to see now how it's cheaper for you. It's cheaper per unit. Because you have a roommate now, for each of you, it's 500. Now let's say you get a third roommate. All right, your rent is still 1,000 a month. You still owe your landlord 1,000 a month. But now it's $333.333 whatever infinity, okay? And let's say you want to live in like a clown a circus, okay? You want to be 4 people, all right? I'm not, you know, I still live with my parents, so I live with 4 people, so I guess I live in a circus too. It'd be $250 per month because it's 1,000. You're 4 people, so that's $250. So I want everyone to see here the relationship I'm talking about. I want you to take this gibberish and I want you to put it into understanding. How variable cost, guys. No matter if you want to make 1 unit, 2 units, 3 units, it's still the same per unit. It's just going to cost you more in total. Whereas fixed cost, guys, it's always the same no matter what. But now the more you produce, like the cheaper it is. Like think of it, guys. If you buy a bike, right? And it's like $1,000 and you ride it once. You could argue that's like, oh yeah, it's $1,000 per bike ride. But now when I ride my bike 2 times, it's like $500 per bike ride. 3 times, and you, etc. I want you guys to understand that. You could, like the way to explain to you guys, it's like you're getting more value out of it. It seems cheaper per unit because you're using it more. You're getting that value. Does everyone understand? That's how fixed costs change per unit. Remember, same in total, change per unit. And that's the relationship I want you guys to understand. Because guys, if your production changes, let's say the previous example, you're making 10,000, now you make 20,000. Well, your variable cost per unit is staying the same, but now since you're making more units, you could argue your fixed cost per unit has actually gone down. The reason being is if you're using your factory more, you can argue that you're getting more value out of it. Does everyone understand that? Are units with fluctuating prices such as petroleum variable costs? So are units of petroleum, you consider variable costs, yes, because you want to like if you have a car, obviously like your cost always like, it's the price of gas would be same per unit. Well, like cost of gas is always changing. So like, I wouldn't think about it like that as an example. Just no variable cost is a cost that does not change. I would argue maybe like the stuff they use to make gas. You know, I'm no chemical engineer, but like that's exactly what you would like look at. What are the costs of making the gas? All right. Fluctuating prices have to do with selling, and that's not what we're doing here. We're only looking at costs. Is that okay? Is everyone okay so far? Have I lost anyone? Variable costs are fixed per unit. Fixed costs are variable per unit. I know it sounds like gibberish, but it's something you guys have to understand on your exam. Go speak to friends. You can always send me a message later. You have to understand it. You will get a question like this 10,000% on your midterm. Can we say fixed costs always decrease per unit? Exactly. Well, no, wait. The more you make, right? It depends. Your fixed cost could go up or it could go down per unit, depending if you like make less or more, right? The more you make, the lower your fixed cost will be. The less you make, the higher your fixed cost will be. That's like outside this, like you could think about that later when you're on your own time, but for now we got to keep moving. I gave you guys the relationship. This is where you have to go practice now and go practice problems like this. All right. So you're going to see a lot more variable costs and fixed costs in chapter 6. All right. Now guys, I feel like I'm going at a good pace here. Okay. Now we're at the last part of the chapter. last part of the theory portion of the chapter, and we are doing some statements. Now, I'm sure a lot of you maybe now have like PTSD from Com 217 and you're scared of the income statement. I guarantee you, this is why I like to say 217 is easier than 305, because the income statement is different in Com 305. The reason is, guys, remember I spoke about at the beginning of the tutorial. Com 305 is for managers. It's for people within the company. These reports don't have to go out to the public. As a result, they're filled with essential information, not everything that you see on the external statements. As a result, they are much simpler to make and much quicker to make. Now, to give you guys these statements, I'll show you guys essentially like how these, like the macro version of these statements. So let's talk about the statements now. The macro level version of these statements. Wait, did I just skip any questions for variable cost and fixed cost? Does anyone have any questions about that? I'm so sorry if I'm going fast. Any question about variable cost and fixed cost? I'm sure you guys like get the relationship, what you mean by like wage and rent. But if not, don't be shy. Okay, so I guess I'll move on. So guys, these are the statements we're doing, okay? And first off, I'm gonna show you guys how these statements, like what we're doing here essentially. So first off, essentially what these statements represent is everything you do from manufacturing to selling the product. In managerial accounting, it's called the cost flow. Now, the way these costs flow, guys, it mimics the manufacturing process. So as you're buying material, as you're incurring labor costs, and as you're incurring overhead costs, is when you will go add these costs into your statement, okay? So essentially this is how it works. And you guys know how to make products at this point. So we're, like I said, we're just taking what you already know, but we're putting it in a managerial accounting perspective. So first off, guys, you're gonna be getting, this is not actually the statement itself, it's like the explanation for the statement. So I'll put like explanation here actually, guys. Sorry if I make you guys erase stuff. So first off, manufacturing costs. All right, guys. So as a business, okay, when we want to make a product, we already spoke about this. We need DM, we need material, we need workers, we need DL, and we lastly need overhead, MOH, okay? So we're buying material, we're buying labor, and we're incurring overhead costs. Now, this is how it works. You buy all these stuff, then it's time to start making your product. What we call that is we call that the work in process account, okay? You take this material and you put it into work because you're starting a job. You take these labor workers, you get them off the couch, you send them to work because now they're gonna make your product. And overhead, you take that overhead cost and you put it into work because now you're making the product, all right? That is how it works in real life, guys. I'm sure you guys know that at this point. Now, this is where the product's being worked on, okay? The product's being made, all right? It's going through the machines. People are touching stuff, you know, well, not touching stuff. I should rephrase that. People are touching the product and making it, okay? Now, we have this work in process. WIP, W-I-P. Sorry, I know my handwriting's bad. WIP, work in process. And you guys will be seeing this in chapter 3. I'm just like giving you like the really bare bones version of it. You take material, you take labor, you take overhead, you put it into work because now you want to start making products, all right? Now, guys, it goes into work, it's being made. Now, when it's done, you take the costs out of the work in process account and you move it into your finished goods account, all right? Finished goods, your inventory, all right? I'll even write inventory here just to visualize it for you guys. Does that make sense to everyone? You put your manufacturing costs into work. When the job is done, it is then finished. You can sell it. So it's in your inventory account. And then lastly, guys, the way something leaves your inventory account is when you sell it. So COGS, cost of goods sold. That is essentially how it works, guys, in real life. From manufacturing to selling. What we're doing in managerial accounting, guys, is we are just tracking everything from production to the sale itself. We don't track anything after the sale. It's everything before the product is sold, okay? That is what we're doing here, okay? Now, in tracking these costs, because your manager is going to want to know the deal, what's going on, we make 2 statements to illustrate this process for you, okay? Does anyone have any questions, really basic questions about this process? You'll be seeing it in specific in chapter 3. I'm just telling you how it works now. Does anyone have any questions specific? You get labor, you get material, you get overhead, you put it to work. When it's done being worked on, you move it to your inventory because you could sell it, and then you report it as a sale in cost of goods sold. Could we quickly review the flow? For sure. So as a manager, I'm gonna buy direct material, right? I'm gonna buy wood, I'm gonna buy nails, screws, whatever it may be to make this product. I'm then gonna get my workers to work, all right? I'm then going to go buy a factory. My factory's going to depreciate. I'm going to incur factory taxes, heating, utilities, whatever. All right. So when I start my job, I'm going to move all the costs from those specific accounts into work in process. The whole point, guys, of a managerial accounting system is it has to literally mimic the actual manufacturing process. That is what you're doing here. You're just looking at the actual manufacturing process in a cost perspective. So COGS is essentially the cost of inventory. Yeah, think about what COGS means. Cost of goods, all right here. Cost of goods sold. All right, cost of goods sold, guys, is the cost of what you're selling, right? Literally just like reverse the words around. Cost of goods sold is the cost of what you are selling. It's the cost of goods that you're selling. That's what literally cost of goods sold means, right? So what we're doing here is we're just putting statements on what actually happens in real life. Because the guys in a managerial accounting system, you have to track your costs, right? When stuff happens on the production floor, it has to happen in your managerial accounting as well. Okay, and that's why the companies go spend like all these tons of money on like ERPs and like I'm not in BTM or supply chain, and like I don't know the whole like process like in depth on a high level, but on a very low level, you need like companies will go invest millions of dollars to make sure this process can be tracked as efficiently as possible, so you could track your costs and then make like have more accurate representation of your profits. That is what you're doing in this course. The amount would be the exact same on all three levels. What do you mean? What do you mean it's the exact same? Sorry, I don't follow what you mean by that. Oh, it would be the exact same, yeah. So let's say it cost you $100, okay? You finish the work. You determined your work, like if the amount it cost you, like make a pair of Yeezys was $100, okay? These $100, when the Yeezys are done in production, they're gonna get transferred to the warehouse where they're gonna then be sold, okay? So this $100 is gonna be transferred right to here. So it's $100 here. And then when you sell it, the cost of goods sold is also $100, okay? Because it's a cost of goods that you sell. It's not the sales dollars. What you sell something for is different than the cost of making it. Imagine buying an Apple product like at the cost of making it, not paying an insane markup. If that's what you mean, the cost essentially here is the same on all three levels, from WIP, inventory, cost of goods sold, okay? What you sell something for is a completely different story. We're not talking about what we sell it for here. We're talking only about the cost of making it. Would it increase the cost of storing it in inventory or something? So the cost of like extra storage and stuff is period expenses, right? It's like stuff you need to sell the product. Your inventory, like if you like, depending on like if you're inventorying like a lot of costs, that can go to like different types of operating expenses, all right? Because you need that to sell it. Now everyone, now that you guys got the gist of the manufacturing process, let's put it into statements. So essentially guys, the left-hand side of this process, we have a statement for the left side and we have a statement for the right side. Or actually we have a statement for like 3/4 of it and then we have a statement for like 1/4, okay? So for this left-hand side of the statement, we have to do the COG-M schedule. Actually, I'll write it all out. The cost of goods manufactured schedule. All right, because we have to figure out how much this inventory costs. All right, so let's go get into the COG-M schedule. So for our cost of goods manufactured schedule, all right, I'm just going to start it right here. The very first line, and guys, it's different. The way I do the statement is much more simple than how you see it in your Wiley assignment. Needless to say, guys, you have to know how to do it the Wiley way. So just go look at your homework assignment for that, but I'm going to show you how to do it in a very simple way. All right. So guys, the very first line of your cost of goods manufactured schedule is your DM used. How much material did I use in making these products? Now guys, if I want to find my DM used, I have to do some sub calculations. All right. So if I want to find my DM used, I first have to take my beginning balance of direct material. Okay. Then I have to find out how much DM I purchased. So plus purchases of DM. And then lastly, I have to minus my ending DM. All right. So your beginning plus whatever you buy minus whatever you have at the end will tell you how much you used. Okay. Let's put that little arrow over here to indicate some numbers. We'll just put some numbers here. Okay. That's how you find the DM used. Now, guys, from there, we have to add the direct labor. Okay. We add DM, we add DL, and then we add our manufacturing overhead costs. And that gives us the total manufacturing cost. Okay, so DM, DL plus MOH gives us the total cost of making our product. Is that fair to everyone so far? Remember we looked at that a bit earlier, the total manufacturing cost, DM, DL plus MOH. All right. Now, guys, if we want to find out the cost that we made, essentially, guys, here, we have a beginning work in process. What that means is, guys, is some jobs aren't finished within the same period. Okay, some jobs take a long time. So as a result, guys, we have to add all the work that we did last period. That's what the beginning work in process represents. Beginning WIP. Okay, so you add your manufacturing cost plus the work that you did last period, which is your beginning WIP. That gives you the total work in process. All right, so that's the total value that you have in your work in process account. Then what you're going to do is you're going to minus your ending work in process, or ending WIP rather. I'll start using abbreviations to make this go a little bit faster. Just put some lines here. And then after you minus your ending, that gives you your cost of goods manufactured. Is that okay with everyone? All right, that's how we do the statement. In your Wiley assignment, guys, they like to do beginning WIP up here and then add it to the total manufacturing cost. And it just makes the statement a lot more annoying to do, to be honest. Like, I don't know, like it's so much easier just to put it here than to put it on the top and then add it afterwards. So just look at your Wiley assignment. They do it like that. I do it like this because it's easier, because I like to keep things simple. Is that okay with everyone so far? All right, that is our state cost of goods manufactured schedule. Now, guys, I'm actually going to move this a little bit over because I want to go do the income statement side by side. So let's squeeze this as much to the side as I can. All right, now everyone, let's go do the income statement. And you guys are going to see now, I'm sure a lot of you are scared from 217. The income statement is a lot easier than 305 in 305. So let's go through it because it's just for managers, right? It's not for any external stakeholders. So it could be done much more simply. So this is how we do a statement in COM 305. So first off, the first line of any income statement is your sales. Okay? Is that fair to everyone? How much you sell is the first line of your income statement. From there, you have to minus your cost. Oh, sorry, from there, oops. Yeah, you minus sales, minus COGS. Oops, I almost messed that up. Cost of goods sold. Okay? And now, guys, how we get that cost of goods sold is we have to calculate it. This is how we're going to calculate it. First off, we have to add our beginning finished goods. And guys, I've used the abbreviation here, inventory. In COM 305, we call it finished goods inventory. All right? Because it's a finished good, it's done. All right? So in front of inventory, write finished goods because that's the new name of inventory. You're not calling it inventory anymore. You're calling it finished goods inventory. All right? So you have your beginning finished goods inventory. That's all the units that you had in your warehouse at the end of the period. It's essentially everything you didn't sell. Okay? Next, you're going to add your COGM, your cost of goods manufactured. So I'm going to write COGM, guys, because cost of goods manufactured, it's COGM. So plus COGM. All right? And then you have to minus your ending finished goods. So your beginning finished goods plus your COGM minus your ending finished goods will give you your cost of goods sold. Okay? I hope that's okay with everyone so far. Now, when you do sales minus cost of goods sold, that gives you your gross profit. All right? From there, when we have our gross profit, we minus all our period expenses. And then that gives us our operating income or net income before tax, whatever you want to call it. All right. And from there, you can minus taxes. Like this part's not important, but we'll do it, whatever. Minus taxes equals net income. And reality is, guys, is these last two lines aren't important for 305. All right. You won't see this often. So I'll even put like a highlight on it. Like doesn't come up, right? Because we only care about the operating income. We're not concerned with like external taxes and stuff. Everything's just for the manager. Is the minus next to cost of goods sold? Yeah, it's a minus. This is a minus right here. Okay. So guys, those are the two statements. As you guys can see in COM 305, the statements are much more simple. Okay. is not these giant statements that you see in 217, because everything's for a manager, it's for internal purposes. Now, guys, how I like to do my tutorials and how I like, that's just how I do things. I always give you guys the theory and some information, and then I always talk about like problem solving strategy. Okay, I'm very big on that. And Dr. Ali always says this when he's talking about COM 305. COM 305 is a system. You have to know theory, like you have to have good understanding, but you also have to know the system on how to solve problems. Now, guys, when you solve these problems, luckily for you, it's exactly like solving a puzzle, okay? It won't even feel like you're doing COM 305. You are just putting stuff in with theory, and then you're using algebra on the rest. And you guys are gonna see when we solve problems, that's what we're gonna do, okay? So don't get overcomplicated by these statements. They're pretty simple. What you do have to look for is here, and I want you guys to notice this. So let me get like a blue marker here, I guess, is I want everyone to see this line here. See the cog M when we're finding cost of goods sold, because on your midterm exam, this is what's gonna happen. They're gonna ask you to find the cost of goods sold. Okay, they'll ask you, what's the cost of your goods? And students will just go do the income statement because it has cost of goods sold. Oh, that's what they're asking me? I must do the income statement. What students fail to realize is you can't find the cost of goods sold without the cost of goods manufactured. So I want everyone to see this. On your exam, you'll have to do the cost of goods manufactured schedule. And I want everyone to notice the very last line here. The very last line here is your cost of goods manufactured schedule. So this is what I like to do. I do this little arrow because on the exam, you're gonna have to do the cost of goods manufactured schedule and then go and then plug it. Why isn't my line going straight? And then go plug it right up over here to find your cost of goods sold. The key thing I'm trying to get you guys to understand here is one statement is needed to solve the other. Okay? I want everyone to understand that because they'll get stuck trying to find the cost of goods sold without finding the cost of goods manufactured. Remember, guys, on your exam, like when you see a question like this, do the two statements right away. No ifs, ands, or buts, because you guys know one will lead to the other. It won't be just that simple. You won't only have to do an income statement and then just use basic algebra to find it. You'll have to do the cost of goods manufactured schedule and the income statement. Now, a lot of people are thinking now, Matthew, this is so time consuming. I can see why people are struggling with these classes. I have to do two statements, maybe for 5 problems in a row. At that point, I'm just going to tell you, yeah, that's just how it is, guys. But if it makes you feel better, you can practice writing these things down and get fast at them. When I was doing my exam in person, I would not even joking with you guys, you got to get these statements done in under 10 seconds, in 10 seconds. I could write this statement so fast. You got to get quick at doing that because you literally might have 5 problems in a row where you have to do these two statements back to back to back. Okay? So cost of goods sold is beginning finished goods plus COGM minus ending finished goods. Exactly. All right? Then you do sales minus cost of goods sold, gives you gross profit, minus all your period expenses, gives you your operating income. Does everyone understand that in problems? Okay? One statement is needed to solve the other. You need the COGM schedule to do the income statement. Now, I want to go through the next thing because we have to be good at what to put where. So guys, these beginning direct materials, these endings, these beginning whips, these endings, these beginning finished goods, and these endings. Okay? Now guys, they won't tell you beginning finished goods is like $100. They're not going to say that. Instead, they're going to give you days of the month. And luckily for you, it's very easy to see which day is the beginning of the month and which day is the end of the month. So let's say here, guys, at January 1st, our direct material, I'm not going to say beginning, I already just gave it away. On January 1st, DM balance is $100. Okay? So guys, I encourage you to understand and look at a calendar that the first of the month is the beginning of the month. Okay? So January 1st is beginning. Okay? Now, I tell you January 31st. I'm not even kidding you. Some students screw this up. It's why I like to simplify this so much. January 31st, guys, do you think it's the beginning of the month or the end of the month? What do you think? Is January 1st the beginning or the end of the month? Very simple question. Very good. January 31st is the end. Okay, let's say the balance January 1st was $200. Your DM balance is 200, in which case you plug in 100 here and 200 over here, and then they'll tell you how much you bought and blah, blah, blah. Okay? So I want you guys to understand what's the beginning of the month and what's the end of the month. Another trick on the exam, okay? What if they were doing a COGM schedule for January, okay? What if I was giving you a COGM schedule for January and I told you my balance at December 31st is, my balance of DM at December 31st was 500 bucks. What if I said it was 500? What does that mean? Do you guys think that's the beginning or the end? What do you guys think? I want everyone to see here. If we're doing a COGM schedule for January, the end of one month, the end of December, then becomes the beginning of January. All right? So be careful that, I'll even write it here. The end of one month is the beginning balance of the next month. Okay? So I'll visualize it here for you guys. So let's say December 31st, we had $100 of DM. When we go to January 1st, that $100 hasn't gone anywhere, just goes right up here. So the end of one month is the beginning of the next. That is what I want you guys to understand. So that's another trick that could like be on the exam. They'll ask you to do a COGM for January, but give you a balance at December 31st. You just have to know the end of one month is the beginning of the next. Are we okay? Does everyone understand what I'm saying so far? Have I lost anyone? Does anyone have any concerns, contagious panic attacks, literally anything? Now's the time to ask a question. Literally anything. Seriously, guys, it's a friendly environment. Don't be shy. If anyone knows me in person, they know like you can always ask me any question anytime. Okay? So guys, there's actually one more thing I have to go over. And I actually should have gone over when I'm going over variable cost and fixed cost, but I'm going to go over it now. Okay? The next thing that we actually have to do, I actually completely almost skipped this. I was just realizing it now because I was like in variable cost and fixed cost. I actually didn't do the high-low method. So let's go do that very quickly, actually. So let's do the high-low method. Okay, then we can get into do a little break and then we can get into some problems. Okay, guys, this is what the high-low method is, okay? So let's go back to the whole variable cost and fixed cost thing. So when I told you that variable costs are costs that changes as output changes, okay? And specific how variable costs are fixed per unit, that is only with an asterisk, and I actually want you to put an asterisk next to it, within the relevant range, okay? Put that next to variable costs are fixed per unit. That is within the relevant range. A little back. For variable cost, do we know the relevant range? They'll tell you it in a problem. Guaranteed. They will tell you what it is. I'm going to go over it now, the high-low method. All right, I get so excited in my example, sometimes I go miss something like that. Can't believe I missed doing the high-low method. I just love managerial accounting so much, okay? All right, now, guys, when doing the high-low method, okay, there's a strategy to doing it. So first off, I'm going to give you the equation, okay? Because in the high-low method, essentially what we're doing here is we're finding the variable cost per unit, okay? But that's within the range, and I'm going to explain in just a second. So this is the formula for the high-low method. The VC per unit, okay, is the highest cost minus the lowest cost, all right? And then you have to divide that by the highest activity minus the lowest activity. Okay, I'm going to explain to you guys how we do these problems now. So when doing the high-low method, this is what we have to do. First off, you got to go pick, because a lot of students here, this is the mistake they make. They go pick the cost that's the most expensive, and then they pick the activity. This is what you actually have to do. First off, guys, you're going to go find what that highest activity is, okay? And then you pick the cost that corresponds to it. Then you're going to pick the lowest activity and then pick that cost that corresponds to that. The key is, guys, is you start in the denominator first, and then you pick whatever's in the numerator. Normally, you do it the reverse, like you pick the highest cost and the highest activity. Here, guys, you find the activity first, find that cost that corresponds to it. Then find the lowest activity, and then put the lowest cost that corresponds with it. That is the secret on how to do these problems so you don't screw it up. We deal with the activity first, and then we pick the cost that corresponds. All right? So, everyone, now, what I'm talking about in the relevant range here, okay? So, when we're doing problems, what we have to look at is that range. Essentially what the relevant range is, guys, is the range at which a company normally operates at. So, whoops, why did that go there? What is this? Erase that. How do I get rid of this? One sec. I got like, wouldn't be my iPad with some technical difficulties. 1 second. Okay, go back. Love when that happens. Okay, so, okay, let me get back to that. Sorry, guys. So let's talk about the relevant range. So what the relevant range is the range of output that a company normally operates in or operates at. Okay, so when we're talking about variable costs are the same within the relevant range, this is what I mean. Okay, let's say we're making shoes. Okay, we're making Yeezys. Let's say we've calculated the variable cost per unit as $5. Okay, what I want you guys to realize is for that $5, this is between, okay, let's actually give the range first. Let's just say we make a normal capacity we operate is we make between 10,000 and 20,000 pairs of shoes. Okay, and in that range we calculated, our variable cost is $5 per shoe. All right, now guys, let's say our demand peaks one year where we're going to have to now leave the relevant range. Okay, let's say now our demand is like 30,000, so we want to make more than 20,000. We now want to make 30,000. I have now left my relevant range. What does that mean? Well, that means now I'm going to have to increase my production. So before, guys, while it's $5 in between this range, now I don't know how much it's going to be, because if I want to make 30,000 units, since it's outside of my normal capacity, I may have to go get new employees. I may have to get a new factory. I may have to get so many new assets in order to now go and make this like increased level of production. That is what we're talking about in the range. It's a range where I operate in. If I leave this range, I'm gonna have to get a lot more assets to like go match this production. If I go less, I may fire some employees so I can get like a smaller amount of variable cost per unit. That is what this range is. It's the range of what I operate in. If you leave either of these ranges, your variable cost per unit is going to change and you won't be able to calculate it. Now, this type of question, guys, and honestly, it's very straightforward because you always get the highest activity, lowest activity, and you just pick the costs. And literally, guys, it's just like back to like high school, okay? This is how the problem gets complicated, okay? Dr. Ali will throw theory in there. So this is what he's gonna do. He's gonna ask you, what's the VC per unit at, if you wanna make, let's say, what's the variable cost per unit if you wanna make 30,000, or let's say 20,200 units. And then this is what you're gonna have to say. He's gonna give you like A, B, C, D, and then you're gonna see E here with none of the above. Okay? And I encourage you guys here, when you get this type of question, because I'm guaranteed it's gonna come, that you better highlight none of the above, okay? What is the variable cost per unit at 20,000, if you wanna make 20,200 units? Okay, I want everyone though, I want you guys to now answer this question though. Why is it none of the above? I want you guys to ask me, like, well, tell me why. You guys be the TAs here. If you're asking me for the variable cost at 20,200 units, why is it none of the above? Because I'm outside of that range. Guys, if anything is out of this range, you cannot find that variable cost. There is nothing you can do. All right, well, like, there's like regression analysis and stuff that you'll do in ACO 330. But like, outside of this range, guys, for the sake of your course, if Dr. Ali asks you, what is the variable cost per unit at anything outside the relevant range, you cannot answer that. So none of the above, insufficient, info, okay, whatever it may be. Okay, I want you guys to realize that. The second you leave that range, that variable cost per unit is no longer the same. It's no longer $5, okay? I want everyone to understand that. So how do you find the variable cost per unit? You use the high-low method. That'll find you that variable cost per unit within the range. Now, if you leave the range, that's a whole different ballgame. You can't calculate that, all right? So that's how they'll trick you on the exam. They'll give you a high-low question, find me the variable cost per unit at 20,200, or find me the total cost per unit if you want to make 30,000, in which case you tell Dr. Ali, you know, sorry, bro, I can't do this, okay? Because you're outside of the range, my variable cost per unit, if I'm going to make 30,000 units, I need to get a lot more resources to match that production. Does everyone understand what I'm saying? Is that okay with everyone? Did I go a little bit too far? Did I say too much? Is anyone confused at this point? So just remember, that's the common exam trick. Common exam trick. Asked to find cost outside of our relevant range. Okay? The variable cost could be, if we're making 30,000 units, no, the variable cost would be more because you're going to need to like maybe get a new factory, hire more employees, right? So you're producing more, you're going to have to like get a lot more, right? So that's how the variable cost per unit will change. All right, the fixed cost then will go down, but that's like, so like outside the scope here. All right, I just want you guys to know that because it won't get more complicated than that. Dr. I will give you the high-low method and just cleverly tell you, he might even do this. If the relevant range is 10,000 to 20,000, he might ask you, what's the total cost if you want to make 20,001 units? Okay, that could be a question. In which case, sorry, you can't answer that because even if it's 1 unit, you're still outside of the range. Okay, I want you guys to really be sure of that. You do not ask, you do not answer that question. You put none of the above so fast. Okay, if you find a cost outside of that range, you put none of the above. How would you find the fixed cost? Well, the thing is, you wouldn't actually be able to find the fixed cost as well because when, like, think about it. If you're getting a new, like, if you're outside of your production limits, you may have to get a new factory, in which case you'll have to probably pay rent on that factory. You might have to get a couple new managers, whatever it may be. It's like, so like outside the scope of this class because like we don't know like what they'll need. Well, how do you find it within the range? So this is what you have to do. Okay, if you want to find the variable cost within the range, you just, well, like, this is what you do. Let's say you have 10,000 hours, okay, minus 20,000. So, sorry, pick the highest activity, so that'd be 20,000 hours, minus 10,000 hours. And let's say the cost was like $30,000 here. And then the lowest cost was 20,000. You would just do 10,000 divided by 10,000, in which case your VC per unit would be $1. Okay, you pick the highest activity, pick the cost, then pick the lowest activity, put the cost, punch in your calculator, get it done. As well, confirm the relevant ranges, it's always given to you. They'll always tell you what the company operates in. You don't have to do guesswork, okay? That's not required. Activity is the units, yeah, the units that you make. So they'll tell you sometimes the activity isn't always units, it's like hours as well. They'll tell you like the amount of our employees work could be 10,000 hours to 20,000 hours. So it's whatever activity level they tell you. So our employees work between 10,000 and 20,000 hours at this cost, all right? What happens if they work 30,000 hours, right? Well, now you'll have to pay them overtime and maybe different types of benefits. Maybe you might get a lawsuit. So the VC per unit now changes, okay? What happens if your employees work 30,000 hours? Sorry, I can't find it, can't calculate it, all right? So the activity could be whatever they tell you in the problem, all right? You'll be able to very obviously tell that's an activity, okay? Because like you can differentiate between cost and like hours or units, all right? So guys, that is the theory portion of chapter 2. What we're going to do now here is, guys, we're going to go take a 15-minute break, and then afterwards, we're starting to bang out some problems, okay? So the problems can be found on your Moodle, all right? So I encourage you guys to go get those problems and go solve them.